Why printing more money isn't the solution. The economic consequences of government money printing explained. Money is an embedded item in our life recipe. A typical person finds it impossible to go a day without touching money. But there is a lot behind this money. When we were kids, we would have believed that the government could expand money printing even just once if we ran out of cash. But increasing the money supply won't help. Your first thought will be, why isn't the problem solved by printing more money? Don't worry. In today's video, I'll outline why printing more money isn't always the solution and the economic consequences that may arise from government money printing. Without further delay, let's get into the video. Money printing becomes necessary for a number of reasons. To replace worn out, damaged, or outdated currency in circulation is one such reason. Another justification is to increase the economy's money supply in order to spur economic expansion and lower unemployment. Governments may also issue currency to pay for substantial military expenditures, social welfare initiatives, or infrastructure building. During times of economic crisis, such as a recession or financial market crash, central banks may print money to provide liquidity to the banking system and prevent a widespread financial collapse. This can help stabilize the economy by boosting consumer and investor confidence, encouraging borrowing and investment, and stimulating economic activity. But before expanding the money supply, it is important to take into account the possibility of other economic issues brought on by excessive money production. When it comes to economic policy, the issue of printing additional money is a highly debated topic. Printing more money, also known as monetary expansion, can seem like a quick fix to address economic problem. One advantage is that it may short-term increase economic growth. The government can make more money available for firms and individuals to spend by expanding the money supply, which could result in an uptick in economic activity. Furthermore, by using the newly created money to settle bills, printing more money can help the government's debt load. It's crucial to remember that these advantages are frequently transient and may, in the long run, be overshadowed by the negative effects of inflation and a depreciated currency. Before knowing the consequences of money, it is important to understand who prints and controls the money supply. In most countries, the central bank is responsible for printing money. Physical and digital currency can both be printed by the central bank. But the central bank doesn't always decide to generate money on its own. It frequently works coordinated with the government, which may have different priorities and goals. Also, the control of an economy's money supply is mostly the responsibility of central banks. Their principal duties are to protect price stability and encourage economic expansion. Open market operations, reserve requirements, and discount rates are just a few of the methods that central banks employ to control the money supply. In order to affect the money supply and interest rates, open market operations entail purchasing or selling government securities. The percentage of deposits that banks must retain in reserves in order to comply with reserve requirements might limit the amount of money that is available for lending. The discount rate, which affects the cost of borrowing and spending in the economy, is the interest rate at which banks can borrow money from the central bank. By managing the money supply and money printing, central banks can help to promote economic stability and growth. The acts performed by a central bank or other monetary authority to affect the supply and demand of money and credit in an economy are referred to as government monetary policy. Government monetary policy can have a big impact on the economy since it can change inflation, interest rates, and economic growth. The quantity of money available for lending and borrowing can be affected by monetary policy tools including changing interest rates, purchasing or selling government assets, and reserve requirements, which can have an impact on the economy as a whole. You may think excessive money supply is an easy solution, but why it is addressed as a risk. Excessive money supply refers to a situation where there is an abundance of money in circulation relative to the demand for it. Inflation, currency devaluation, economic instability, and a decline in foreign investment are all hazards associated with overprinting money. When there is an excess of money in circulation, inflation happens, which results in an overall rise in prices. The supply of money in circulation rises when a government produces additional currency, which lowers the currency's value. Because it costs more money to buy the same number of products or services due to the currency's decline in value, prices for goods and services increase. Changes in the stock and commodity markets can lead to economic instability and a loss of investor confidence. Money supply expansion also results in currency depreciation. A weak currency can also increase the cost of imports, raising costs for both consumers and companies. Additionally, it can boost export demand and enhance the trade balance by lowering the cost of exports. Because it lowers customers' purchasing power and depreciates savings, the ensuing inflation can be harmful to an economy. Last but not least, a weakening currency may cause a decline in foreign investment. These dangers can harm an economy for a very long time, underscoring the significance of properly weighing the possible effects of monetary measures. As the same hyperinflation, a fast and uncontrollable rise in prices, can result from uncontrolled money printing. This happens when the money supply grows quickly, but the demand for goods and services either declines or stays the same. Rapid price increases may cause people to lose faith in the money, making it worthless. Economic unrest, a drop in investment, and a reduction in consumer purchasing power can all be brought on by hyperinflation. Political instability and societal discontent are some possible outcomes. Governments must make sure that the money supply is strictly controlled and that the rate of money creation does not exceed the rate of economic growth in order to prevent hyperinflation. While increasing the money supply may appear to be a solution to some economic issues, doing so frequently has worse long-term effects. The consequences of government money printing can be severe, long-lasting, and the consequences may end up in economic turmoil. Economic turmoil is a time when the economy is unstable or unpredictable and is marked by a number of unfavorable economic indicators, including high inflation, high unemployment, slowing economic growth, and waning consumer and investor confidence. Numerous reasons, including both internal and external ones like government policies or poor management, can contribute to economic unrest. External causes include things like global economic shocks. If not carefully implemented, the policy of printing more money can cause economic turmoil as it can exacerbate already existing issues like inflation and a weakening currency, which could result in a loss of confidence in the economy, a flight of capital, and a decline in investment. It is frequently ineffective to fix economic problems by printing more money because doing so might have unfavorable effects. Simply expanding the money supply will not solve the underlying reasons of the economy's problems, such as unemployment or low productivity. Instead, by lowering the value of money and eroding investor trust, it can make already existing issues worse. In order to effectively handle economic difficulties, governments must carefully evaluate the potential effects of their monetary policies and take a comprehensive approach, which may involve enacting structural reforms, making investments in infrastructure and education, and encouraging entrepreneurship and innovation. In economics, it is crucial to understand how the money supply and interest rates interact. More money is available for lending when the money supply rises, which may result in lower interest rates. This is due to banks having more money to lend and the possibility of lower interest rates due to competition for borrowers. On the other hand, if the money supply falls, there will be less money available for lending, which could result in higher interest rates. This is because banks may need to charge higher interest rates to entice borrowers, given that they have less money to lend. When establishing monetary policy, authorities should take into account this relationship between the money supply and interest rates. In conclusion, even though it may appear like a simple solution to issues with the economy like unemployment or inflation, printing additional money can have negative long-term effects on the economy. Excessive money printing can result in hyperinflation, inflation, and a decline in the value of the currency. It may also result in economic instability, a decline in trust in the government and the central bank, and uncertainty for investors and enterprises. Therefore, while making monetary policy decisions, governments and central banks must carefully assess the potential effects of expanding the money supply and balance the short-term advantages with the long-term hazards. I sincerely hope you enjoyed and learned something from this video. Knowing something about the economics is always useful. Don't forget to share this video with your family and friends to help them learn more about money. Thank you for watching, and I will meet you soon with another entertaining video. Until then, like, comment, share, subscribe, and stay tuned with our channel.